The future of the housing market has everything to do with the direction of interest rates. If we see interest rates continue to move up, we're likely to see less buyer demand and in turn, lower house prices. Whereas if we see interest rates move lower, we're likely to see a pickup in buyer demand along with further stability in house prices, providing that bottom that everyone has been waiting for. This past week, we got news that year over year inflation has fallen for 9 consecutive months, with US inflation easing to just 5% in March. But please remember, we're still significantly above the Fed's target rate of 2%. And because of that, we're not seeing nearly the reaction that we thought we would with regards to Fed comments, with regards to interest rates, coming off news that the Fed rate hikes are starting to take hold. In fact, it can be quite confusing. We have two top Fed officials basically saying two different things with regards to the Fed and their plans on hiking interest rates further into the future. On one side of the table, we have Christopher Waller, who is a member of the Federal Reserve Board of Governors, saying that he sees the need for further interest rate hikes as inflation is way too high. And on the other side, you have the Fed's Goolsbee, who is the president of the Federal Reserve Board of Chicago, saying that he doesn't want to comment yet and wants to see further data. In addition, he goes on to say that let's be mindful that we've raised a lot, and some of the lag is coming possibly in the retail sales numbers, which show that Americans have pulled back on big ticket purchases. And then in the middle, we have the president of the Federal Reserve Bank of Atlanta, Bostic, saying that the Fed can hit the mark and hold with just one more rate hike. Bostic said he felt the aggressive rate hikes of last year, which pushed the policy rate from near zero level, are now starting to bite on the economy. And that's a reason that he believes it's a good reason to pause after just one more rate hike. And that's because he wants to try to limit the damage to growth and jobs. And even though US jobless claims remain at historically low levels, we're starting to see the numbers rise to the highest level we've seen since January of 2022. So by the looks of it, it looks like the economy is slowing. And a slowing economy is deflationary by nature, which means that inflation is likely to continue coming down. On top of that, shelter inflation is officially showing signs of topping out, even though it's sitting at its highest point since 1982. Month-over-month shelter rose just 0.66% in March compared to 0.79% in February, where at the same time, month-over-month rent rose just 0.45%, which is down from 0.71% in February. So we're starting to see a rapid cool down in rent growth. But here's the thing, it takes nearly 12 months for shelter to catch up on the CPI data, which is a huge lag and exactly why it might take a couple more months before we really start to see it reflect in the data. But here's the thing, CPI fell nearly 1% from 6% in February to 5% in March. And here's the thing, if we take a look at the next 3 months, we have April, May, and June totaling nearly 2.5% of the inflation numbers that we're currently seeing. And as we start to see the shelter data reflect over the next couple of months, we're likely to see that 2.5% replaced with numbers anywhere between 0.3 and 0.9%. But let's assume a 0.2% increase over the next 3 months. And if that's the case, we're likely to see year-over-year inflation sitting somewhere around 3% at the end of June. Now, I realize that's a major assumption, but we do know that shelter data is going to continue to improve, which is going to get us closer to the Fed's 2% target. But here's the thing, we've seen inflation come down, we've seen disappointing retail sales, we've seen job numbers starting to get worse, and paradoxically, we've actually seen bonds sell off and interest rates not really improve as much as we would have thought. Now, if you've watched my videos before, you've heard me say that interest rates tend to follow inflation. So as inflation comes down, we usually see interest rates to continue to follow the same trend, which would mean interest rates would move lower. But this past week, we saw inflation numbers improve. We actually saw signs that the economy is starting to soften. And as you know, bad news for the economy usually means good news for interest rates. But right now, we're actually not seeing that happen. And a lot of it has to do with what we discussed earlier, the Fed sending mixed signals to the market about the future of interest rate hikes. But this is where I want to reach out to you guys. Where do you think the economy is headed? Do you believe we're headed into a recession? Do you believe that we're going to see higher interest rates? What are your thoughts? I'd love to know. Do me a favor, leave it in the comments below. I just want to take a minute and say thank you for the continued support. If you don't subscribe to the channel, do me a favor and hit that subscribe button. And if you find any value in my videos at all, do me a favor and hit that thumbs up. Now, here's the thing. A lot of you think because I'm a real estate agent, I want to see interest rates move much lower. And in fact, that couldn't be further from the truth. What I would like to see is interest rates improve a little bit, maybe move somewhere to the mid 4.5% to 5% range, because I believe that would give sellers the ability to sell their homes, put their homes on the market. You know, those that have super low interest rates that have essentially been locked into their homes, that would give them some incentive. Yeah, the rate's going to be higher than what they currently have on their mortgage now, but it's a hell of a lot better than interest rates in the mid 6% range. And at the same time, it would improve housing affordability. It would give buyers an opportunity to be able to afford a little bit more mortgage, and in turn likely get us out of the stalemate that we're currently sitting in. Because here's the thing, if interest rates go too low, we know that that's going to cause home buyer demand to actually jump, which is exactly what we saw when interest rates recently moved to 2-month lows. Now here's the thing, I started the video by saying that the future of the housing market depends on interest rates, and that's mostly true. The part that I didn't mention is that the other part of the future of housing largely depends on where inventory comes from. Because here's the thing, regardless of what actually happens with interest rates, supply and demand continue to drive the housing market. And at the moment, we have a limited number of homes available on the market, which is exactly why you see the craziness as soon as interest rates go down just a little bit, because there's not a lot of homes for buyers to choose from. As you can see from this chart here, we're sitting at somewhere around 410,000 homes nationwide, which may seem like a lot of homes, but it's not. And the major reason we're not seeing an increase in these numbers, we're not seeing inventory increases, because we're not seeing new listings come to the market. I feel like it's always good in these situations to provide a little bit of historical context when it comes to inventory. And this time we're going to look at weekly inventory numbers coming to the market in 2023. This past week, we saw just 55,000 new listings come to the market, which is just below the 63,000 that we saw come on the same week last year, and still below the 61,000 that we saw back in 2021. But here's the key, those were crazy years in the market, so it's really hard to compare year over year to those numbers. So what we like to do is go back and look at numbers prior to the craziness. Let's say 2015, 2016, 2017, where this same week would have produced around 85,000 listings. So we have less new properties coming to the market, which is exactly why inventory levels are staying tight. And unless you see a flood of new inventory come to the market, you're likely to see much of what we've seen over the last couple of weeks, which is exactly why Redfin is reporting that demand is outpacing limited supply and making some markets feel hype despite the fewer number of sales happening. So remember, if you're planning on buying a home, just make sure you're paying attention to your local market. Real estate is local. My market here in Southern California is still very, very hot with a limited supply of homes, whereas other markets across the country have started to slow down. You're seeing bigger price reductions in those markets, and you're seeing inventory start to build. So just make sure if you're out there, you're working with a professional, you have a longer term time horizon, you have money in the bank, and you're 100% comfortable with the monthly payment.